Okay, now there were two questions about the exam itself. Can you please let me know what those are and I'll share the answers. You had a question about the exam itself. What was the question?
So when you're taking a test, does it have to be like question by question, or do you see them all at once?
You will see them all at once, and my best advice to you is to answer the easy ones first and then go back and do the hard ones because they're all worth the same amount of points. Good question. Someone else had a question.
Yeah, I was just curious if it was set up more like the homework problems or practice.
It's more like the practice is better preparation. The practice is better preparation. My point in providing the homework to you is so that you guys can earn some points, because some of you will not do well on the exams. It's just sad, but it's the truth. Okay.
The practice questions that, like the concept checking question that we have with the chapters.
Concepts are important. They're going to be half the exam.
They also have, like for chapter 4 and 3, they also have numerical questions. Do you recommend doing that as well?
I recommend doing anything that I've assigned to you. I don't just assign crap because I think it's cute.
Remember the problems we went over last time, like EF10? Like there are no practice about those ones.
This is good. She's asking about long-term external financing needed, and she says there are no practice or homework on that. And as I've mentioned earlier, you can tell what I think is necessarily important by what I've assigned, right? Am I telling you enough without telling you too much there?
So that's not what I mean.
So if I were you, I think I would spend my study time elsewhere, but it's good that you asked. Thank you. Other questions? Oh yeah, that stuff would just cripple you. I'm sorry. That stuff is very difficult. Other questions? Okay, shall we get to work on this? We're going to work these in numerical order. I think this is number 3 on chapter 2 is first up to bat on the practice. Let's see, preview. I should show you the list of who's actually done it so you guys could feel ashamed for those of you who have not done anything. Okay, here we go. Klingon cruisers purchased new cloaking machinery 4 years ago for $4 million. The machinery can be sold to the Romulans today for $3.6 million. Klingon's current balance sheet shows net fixed assets of $2 million, current liabilities of $700,000, net working capital of $216,000. If all the current accounts were liquidated today, the company would receive $1.03 million in cash. Okay, let's talk about what that last thing means. If they're liquidated today, they would receive $1.03 million in cash. So in other words, if they liquidated all the current assets, paid off all the current liabilities, this is what they would get that's left over. And so that, in actuality, is the market value of your net working capital. Go ahead and mark that. That's the market value of your net working capital. By the way, are my numbers slightly different than yours?
Yes.
Yeah, these are algorithmic. They're different for everybody, so you guys just don't say, oh yeah, I got that from Frank, right? Okay, so what is the book value of their total assets today? Okay, so their current balance sheet shows net fixed assets of $2 million. So we're looking at $2 million, and that's the, fixed assets? So, what do I have to find in order to get total assets?
Current.
Yeah, I got to find the current assets. So, let's read back through here and see what they say. They give current balance sheet shows net fixed assets, current liabilities of $700,000, and net working capital of $216,000. Which two pieces of information can I use to get current assets?
Current liabilities and net working capital.
Yeah, so we've got net working capital and is equal to current assets minus current liabilities. So how can I get current assets? It's just NWC plus CL, right? Does that make sense? Okay, so net working capital on the balance sheet is is $216,000. Current liabilities is $700,000. So I think this thing is $916,000. Does that sound right? Okay. So that means I think that the total assets are 2,916,000. Let's see. Oh, there it is. Damn, I'm good. Oh, by the way, I will screw up before the day is out because I'm human, right? Okay. Do you guys see how that worked?
Can you put the?
Well, I kind of got my dangler there. Pesky new computers. Is that better?
Yeah.
Okay, or
I
you
just
could.
can't see that part of the board.
Oh, okay. Okay. Does everyone get that? Okay, now they say, what's the sum of the market value of the net working capital and the market value of the fixed assets? Well, we just got through saying that 1.03 million is the market value of the net working capital. And what's the market value of the fixed assets?
3.6 million.
Yeah, 3.6 million, because it's what we could sell it for today. Does that make sense? So what's the sum of the market value and the market value of the fixed assets? So, because they don't mention any other fixed assets, do they?
No.
Okay, so I'm thinking this is 4.63. Is that what it says?
Yeah.
Woohoo! You see how easy that is?
Yeah.
Yeah. Okay, now the next question is number 5. Masters has sales of 46,700, cost of 16,120, depreciation expense of 2720, interest expense of 1550. The tax rate is 23%. What is the operating cash flow? OCF equal EBIT plus depreciation minus taxes. You don't have that on your note sheet? You should. Okay, so we already have depreciation, 2720. And what did they say the taxes are? Oh, they don't. They tell us the tax rate. And then they give us some information to figure out EBIT. So they give us sales, 46,700. What should I do with the costs? I guess I've already put it up there. I'm going to subtract out 16,120. And then what else should we subtract out before we calculate EBIT?
Depreciation.
Yeah, the depreciation. And the depreciation we said was 2,720. And so my EBIT is, well, I should probably do that on the calculator, right? Let's see if their number's right. I can see their answer below. 46,700 minus 16,120 minus 2720 equals, so I'm getting 27,860, just as they did. Now, EBIT, something we have to subtract out before we can calculate our taxes. What is it? Yeah, the interest. So we're going to subtract out 1,550, and I believe that is 26,310. Is that correct?
Yeah.
Okay. So, how do I figure the taxes now? Yeah, times 0.23, right? So I'm going to go ahead and do my subtraction here so I'll have the right number in. And then I'm going to multiply by 0.23 equal. So I'm getting 60, 51, 30, is that what you get? Okay. Now, in order that, since we went ahead and subtracted that out, we would have net income. We don't actually need net income, do we? Do we already have everything we need to know? I think we do, because we've got EBIT, 27,860, plus 2720, minus the taxes of 6051. I have a feeling they're not going to worry about the 30 cents, but here we go. So I'm just going to have plus minus here to make that a negative. I'm going to add 2,876,0 equals plus 2,720 equal. I'm getting 25,429, which is what they get. Okay, now let's talk really quick about conceptually what is operating cash flow. It's cash flows you're getting from operations. So we're only concerned about operations and we're only concerned about cash. The problem is EBIT has depreciation subtracted out of it. So we've got to add that back. But we have to subtract the taxes out because our taxes are real cash flow. Yeah, anyone who's ever paid them knows, right? And so there's one more question here, and that is, why don't we care about interest? Accountants are under the delusion that interest is an operating cash flow. Are they right?
According to you, no.
According to me, no. So that means no, right? Okay. So, and it's not just me, it's the entire canon of finance. Right? Okay, and we are so much sexier than accountants ever dreamed of being. Back to the story. Any questions? Okay, now we are on to, of course, let's see if I can mark these off and give us a feeling of accomplishment. Now we're on to number 7. Boom, boom. Come on, so lazy. Okay, the 2019 balance sheet of Dry Deck Skate Shop shows long-term debt of $3.1 million. Folks, don't make me compete with you, please. Long-term debt of $3.1 million. The 2020 balance sheet showed long-term debt of $3.3 million. The 2020 income statement showed an interest expense of $105,000. What was the firm's cash flow to creditors during 2020? So here's what you need to know about cash flow to creditors. Cash flow to creditors, and you may see it written other ways, like CFB and whatnot, is equal to the interest, because after all, aren't we paying interest to our creditors? By the way, creditors are people who loan us money. So we're paying money to them, but we have to subtract out any net new debt that we go out and borrow. And it's long-term debt. Always long-term debt, net new long-term debt. Has to be interest-bearing debt. We're not worried about current liabilities here. Okay, so they're telling us how much interest are we paying out to these folks? $105,000, does that sound right? Okay, now minus the net new debt. So what was the debt at the end of the year? 3.3. And what was the debt at the beginning of the year? 3.1. If my math is correct, this is $200,000. Is that right? So we went out and borrowed $200,000 more. We had $105,000 we paid in interest, so we're actually looking at negative $95,000. So the cash flow to creditors was negative, means it actually was cash flow from creditors. Does that make sense? Very good. Okay, let's see. 9D. Okay, Schwert Company shows the following information in its 2020 income statement. They give us sales, they give us costs, they give us other expenses, depreciation expenses, interest expense, they give us taxes, dividends. Oh my goodness. In addition, you're told that the firm issued $4,900 in new equity and redeemed $3,400 in outstanding long-term debt. Let's ask this question. What does redeemed mean? If you redeem a debt, what does that mean? Yeah, you pay it off, right? Okay. So let's see. The question I was asked was, if net fixed assets increased by $25,000 during the year, what was your addition to net working capital? Oh my goodness. Okay, so let's see here. How do we go about that?
That's how we feel.
Yeah, exactly. Okay, so let's. Okay, so if net fixed assets increased by $25,000 during the year, what was the addition to net working capital? So let's flip down here, and it's exactly as I thought. cash flow from assets is equal to cash flow to the bondholders plus the cash flow to the shareholders. And we have another way of coming up with cash flow from assets. Do you remember what it is?
Operating cash flow
Say again.
equal to operating cash flows
Uh-huh.
minus net capital spending
Uh-huh.
minus change in net working capital.
Man, she is on fire. Sweet. Okay, I appreciate that. Okay, so what does that mean? Well, what did they ask us to check for? The change in net working capital. And so I'm going to just do a little bit of math here. If it freaks you out, let me know and I'll explain it. I'm going to move this thing across the line, and that's going to give us the change in net working capital positive over here, equal OCF minus NCS minus CFA. And we know CFA is actually cash flow to bondholders minus cash flow to shareholders. Does that make sense? No, plus, right? Okay, whew. Now I just need to go through and I can distribute that negative sign. You see what I did there? Did I do any magic? Did I violate any laws of mathematics? I don't think that I did. Okay. Now, so what do we need now? We know that if we had operating cash flow, net capital spending, oh wait, do we have net capital spending?
Net capital spending is the increase in net fixed assets.
Very good. Okay, so we already have the, I'm going to go ahead and write that in here, minus $25,000. Does that sound right? Because it went up by 25,000. Okay, now what about the cash flow to the creditors? We know that's interest minus net new debt. Do we know interest? Don't they tell us? Yeah, 13,400. I'm just going to go ahead and we're going to do a little math right here. 13,400 minus the net new debt. And they say, wait a minute, the net new debt, what did they tell us that they did? Yeah, they redeemed how much? 3,400. So net new debt is actually negative, right? Because we're paying it off. And so what is minus a minus?
Plus.
Plus. And it's what, 3,400? 3,400. And so that's 16,800 if my math is correct. Does that look right?
Yes.
Okay. Now, they also want to know about the cash flow to the shareholders. Cash flow to shareholders, if you haven't already thought about it, dividends are a cash flow to shareholders. Do they tell us how much the dividends are?
10,500.
Ooh, thank you very much. Now, it's really minus net new stock, right? And so we got a couple of things going on here. Not only are we issuing new stock, we can repurchase stock. And so we really have to figure out what's going on here. So let's read through and see. They're telling us sales, costs, other expenses, depreciation, interest. Dividends are 10,500, and they issued 4,900 in new equity. So if they're issuing 4,900 in new equity, is that cash flow to shareholders or cash flow from shareholders? From. And so what we're really looking at here is minus, we're going to subtract out that money that we got from the shareholders. Does that make sense? Okay, and how much was it, 4,900? So, if my math is correct, I'm looking at 5,600 there. Is that correct?
Wait, why is it negative?
Okay, so if they issue new shares, so the formula is dividends minus net new debt. The net new debt was how much? They issued 4,900 in new equity, right? And so it's dividends minus the net new debt. And the reason is because that money actually came from the shareholders, didn't go to the shareholders. That's why the formula has a negative sign in it. Good question. Other questions? Now, could someone please tell me if my math is correct?
It's okay.
Thank you.
It's
Okay.
there.
What's that?
It was C.
It was C?
Yeah. They had you figure out all of those so you could figure-
Phew. Damn, I'm good. Okay, so now there's one thing left that I need to figure out. What is it?
Operating cash.
Operating cash flow. So let's get to work on operating cash flow. What's the formula for operating cash flow? EBIT plus depreciation minus taxes. Very good. Okay, so let's get to work on this. What are the sales?
394,000.
394,000 in sales, and we're going to start subtracting out our costs. 300,000. And they give us something else.
Expenses.
Yeah, other expenses are how much? 7,900. Okay, so we've got the other expenses, and we know we're going to have to subtract out our depreciation. And when I subtract all that stuff out, it's going to give me EBIT. Does that make sense? Okay, so get your calculator out. Let's crunch through that, make sure we got the right number. Say again?
I got
It's EBIT, right?
Yeah.
You got how much?
66,600.
Okay, is anyone else getting that number? Okay, so let's look here. We got 94,000 minus 19,500. So we're looking at 370,500. Does that sound right? Oh, yeah, so 74,000, hell, here we go.
You don't trust me.
No one else is chiming in.
I also got that.
That's
I'm not doing the math, I'm just writing down the formulas.
Okay, so how much was it?
66,600.
I would trust y'all if more than one of you would say something. Okay, now, in order to figure our taxes, what do we, oh, they tell us our taxes, right? Yeah. Oh man, that's sweet. So now we've got everything we need, right?
Just add depreciation.
Yeah. So 66,600 plus, how much was our depreciation?
19,500.
19,500. And subtract the taxes, how much are taxes? 18,000 what?
620.
620.
Okay. Okay, so can someone do that math and tell me what is OCF?
67,480. We have it.
Yep, okay. Okay, can someone please take 67,480, subtract 25,000, subtract 16,800, and subtract 5,600?
Do we need to add depreciation to the increase in net fixed assets for net capital spending?
Let's see. Oh, you're right. She is so right. Okay, and why do we need to do that?
The net fixed asset doesn't have depreciation.
Yeah, because your balance sheet does not have depreciation. And so we actually have to add back the depreciation that happened during the year. And so how much was that?
19,000.
Yeah, 19,500. Sorry about that. And so this number should actually be, what, 44,500? 580. So is it 19,580? Oh. Yeah, I can see that. I was asking about that bit. Okay, so does this math that I have on the board now work out? And thanks for the catch on adding depreciation back to the change in net fixed assets. And the reason we have to do that is because that net fixed asset is artificially depressed by the amount of depreciation. And why do I say artificially? Is depreciation a real cash flow? No, so we got to add it back because that also went away during the year. Okay, and so it actually, yeah.
Is that an A question?
Oh, very definitely. So here's my, and I was going to tell you this. What would my advice be to you if you see this question on the exam? Skip it! Oh my goodness, for crying out loud, just skip it, right? If they ask you for operating cash flow, great. Or better if they ask you about cash flow to credit or something like that. But if they ask you for that change in net working capital, run, right?
Good strategy.
Oh yeah. Oh hey, life is all about figuring out how score is kept and playing the game accordingly. And it took me like 30 freaking years to figure that out. So hopefully it's my gift to you today. I'll save you about 8 years of suffering. Okay, questions? All right, we are ready to move on to chapter 3. Okay, practice first. And we are going to do 3 and 5. Look at this. 11 of you haven't even started. For shame. Students come to me after exam 1 and they're like, I don't know why I did so badly. Well, guess what? I'm going to pull this stuff up and I'm going to say, hey, you didn't do the things I told you to do. That was for those of you who haven't done it. For those of you who have done it, thank you very much. Question 3. Y3K has sales of 6389, total assets of 3005, and a debt to equity ratio of 1.6. If the ROE is 10%, what is its net income? So let's talk about a couple of things here. They actually gave us ROE, didn't they? Yeah. So, right off the top of your head, tell me a formula for ROE.
Profit margin times total, TAT,
Yeah.
times, equity multipliers.
Yeah, times the equity multiplier. Can someone else give me another calculation for ROE?
Net income divided by total equity.
Yeah, that's the one I thought you guys were going to throw out first. Okay, now what do we have? We have debt to equity ratio. What can we do with that number to get the equity multiplier?
Or 1 plus debt.
Just add 1, right? Equity multiplier equal 1 plus debt to equity ratio. Okay, so we know this is what, 2.6? Does that make sense? Okay, now what else do we have? We have sales and total assets. Well, guess what? This is just sales over total assets, right? So what did they give us for sales?
6,300.
6389 divided by total assets of 3005. And so that's going to be what goes in there. Let's see, actually, we didn't even have to do this because what is profit margin? Right?
Net income divided by sales.
Say again.
Net income divided by sales.
Yeah, it's net income divided by sales. And so let's see what we get here. So I can actually rearrange this whole thing just to get net income by itself, can I? Let's do the easy way. So ROE, they tell us is 10%. Is that correct? And net income divided by sales.
So it's by 2.
Yeah, and here's something really fun. What about this?
Cancel them.
Yeah, these cancel. We don't even have to worry about that. And then multiply by the equity multiplier, which we said was 2.6. And so all I have to do is say 0.10 equal net income times 2.6. divide by total assets. What were total assets?
3,005.
3,005? Okay, now, how would I solve this on my calculator?
Just multiply that first.
Yeah, I'm going to go 0.1 times 3,005, which is going to give me, what, $300.50? Is equal to net income times 2.6. What do I do next?
Divide by 2.6.
Yeah, divide both sides by 2.6. What is 305 divided by 2.6?
115.5 pages.
Okay, so did you actually do the calculation? Very good. Do you see that? Do we even have to mess with the sales? No. And in fact, if I was really going to be cruel, I could throw you a problem like that and leave sales out altogether, right? Not going to do that. I'm not that. I'm evil, but not that evil. Okay. Any questions about this one before we jump to the next one? Okay. Number 5 on the practice. Assume the following ratios are constant. What does constant mean? Hey, they don't change. So they ask us, what is the sustainable growth rate? What's the formula for sustainable growth rate?
ROE into B
Times B
divided by 1 minus ROE.
times B, right? So all we've really got to figure out is ROE and B. Do we have information to figure out ROE? Yeah, ROE, we just got through saying, is profit margin times total asset turnover times the equity multiplier. What they tell us our profit margin is?
6.3%.
0.5.
Oh, sorry. I was looking-
Yeah, if you're throwing it into a formula, always
Sorry,
make it.
I was looking at my computer. It's
0.059.
Oh, so what does this one say?
0.059.
0.059, you're messing with me.
I know.
Yeah. Okay. Times, what's the total asset turnover on my computer? How about 3? And what's the equity multiplier on my computer?
1.5.
1.5. So, what are we looking at here?
0.26. 0.27.
So,
It says do not run.
yeah, don't round. Oh, by the way, leave numbers in your calculator. In fact, I'm going to demonstrate this to you right now, and I'll show you how to do it. What happened to my calculator? There we go. Okay, here we go. 0.059, which we were given, times 3 times 1.5 equal. I've got this number. I don't want to round it. What should I do? Store it. And how do I do that? This button that says stow. It's like you're going to the stove. You're going to stow this in. What do I hit next?
1.
Yeah, you got to hit one of the numbers. I don't care which one, but just remember where you stuck it. And so I'm going to put, and this is what I always do on my scratch paper. I always make a note of where I put this stuff so I'll be able to remember later. Okay, now, they want us to, we need B. What is B?
Amount we retain.
Yeah, the retention ratio. And what do they give us that'll allow us to get there? Payout ratio. Most common mistake, students throw in the payout ratio instead of the retention ratio. So what are we going to do here? We're going to take 1 minus 0.35, and that is going to be equal to 0.65. So I'm going to go ahead and do that in the calculator so you guys can see it. 1 minus 0.65, 35, sorry. Getting ahead of myself. And that gives us 0.65. What do you think I should do with that number? Yeah, I'm going to store, very good. I'm going to store it in location 2. Okay, now, this is where it gets kind of stinky. And I'm going to show you a trick. Notice that this thing shows up twice. Let's go ahead and calculate that thing. So I'm just going to say, recall 1 times recall 2. That gives me B, which is, I'm now going to put in, and say that is number 3. And so what I'm really looking at here is recall 3 divided by 1 minus recall 3. Does that make sense? Okay, how would you attack this thing? By the way, I better store that, right? Store 3. How are we going to attack this thing next? Mr. Sadai, you seem to be a mathematician.
But we can just store another one by subtracting by 1 and then divide.
Okay, would you like to know an easier way? But he's actually right. You start on the bottom.
Uh-huh.
And so what I'm going to, yes?
Do the 1 minus recall 3 and then do the 1 over.
Oh, she's clever. Look at this. 1
I am a
minus.
mathematician.
Very good. 1 minus recall 3 equals. That's what's on the bottom. But unfortunately, right now, the way we've got this thing figured out is that's on the top. And so what did Ms. Perry say to do? She said, well, there is this nifty button up here that says 1 over x.
It's
Is it?
above the exponent one.
Yeah, it's my eyes are messing with me. So when I hit 1 over x, what does that do? It takes that 0.8 and puts it down below. Does that make sense? Okay, one more step to solve this problem. What is it? Yeah, multiply by recall 3. I'm getting 0.2086. When we make a percentage of that, it's 20.86%, which is exactly what they said it would be. Does that fix you guys up for that one?
So you did, can you explain the 1 over x part again?
Okay, so if I figure out something that's actually on the bottom, the way I can throw it to the bottom is by hitting the 1 over x key. Because that thing we just figured out is x. And if I hit that button, so for instance, if I had 4 and I wanted that 4 on the bottom, I hit that 1 over x key and now it's 1 over 4, so the calculator would say 0.25.
Okay,
Does that make sense?
yes.
Now, you could, if that puzzles you, you can find other ways to go about it, right? I mean, you guys have had at least, what, 3 hours of algebra? I hope. Yeah. Questions?
Yeah, how do you create what you stored?
Oh, very good. First of all, you really don't have to. But secondly, if you're really, really crazy about such things, you can say second memory, second clear work, and it clears that all out. The number you put in next will overwrite the old memory stuff. Other questions? Okay. Oh, here we go. Now we're on to the homework. I think we may actually get these all worked out today. I'm so excited. Turn to Blackboard. Oh wow, look, you all did it. I'm amazed. Is it because there's points associated with it? You're such degenerates. My dogs won't do tricks without treats. I think you guys are the same. Okay, are we ready? Are we ready? Lancaster Bakery has net fixed assets of $329,700. Current assets. I'm going to see if I can make this bigger. Does that help? Maybe. Current assets of $87,200. PE ratio of 12.8. A debt to equity ratio of 1.42. Earnings per share of $1.97. What's the market to book ratio if there are 36,000 shares outstanding? Oh my goodness, what a painful, painful thing. So let's talk about what we've got here. If we are, let's see, where to start? So market to book ratio. So market to book is equal to the market value of the equity divided by the book value of the equity. And they're telling us, do they give us enough information to figure out the assets? Yeah. So let's start there. Total assets is equal to the fixed assets, 329,700. Plus, what's the current? 87,200? Now, you say, why in the world do I care about total assets at this point? Do you see total assets anywhere in this? No, but we have enough information. We're going to get the total assets, we're going to get the equity multiplier, and we're going to use those two pieces of information to figure out the market or the book value of the equity, right? Because this this book value of the equity is actually just what we've been calling TE, total equity. Does that make sense? Okay. Now, they tell us also that the debt to equity ratio is what? How much? 0.42. And so the equity multiplier is just 1 plus 0.42, right? Does that make sense? That's equal to 1.42, and that is total assets over total equity. And so if I want to know how much the total equity is, all I have to do is take the total assets, divide by 1.42. Does that make sense? Okay, how much are our total assets? We just said they are, oh, we didn't even do that math, did we?
Oh, it's 416,900.
How much?
416,900.
416,900? Does anyone agree with her? Very good. Okay, and we're going to divide that by 1.42, and what does that give us for total equity?
293,591.5.
Oh my goodness, can you, 293,
5493. You don't want
let's just do that, right? Because after all, we're talking about dollars and cents here. Does anyone else get this number?
Yes.
Okay, so that's going to go right there. So the only thing we have left is the market value per share. And they give us some share type information here. Actually, we're looking for the market value of the equity. In order to know that, we need to know the share price. But thankfully, they give us PE, which is price per share divided by what? Earnings per share. So if I want to know the price per share, what do I need to do? Mathematically, what do we do?
Price.
Or am I speaking English? Because what I'm hearing back doesn't sound English. Oh, right? How am I going to get price per share by itself?
So price to earnings ratio times earnings per share.
Yeah. So if I take that PE ratio, multiply by EPS, that gives me my price per share. So let's figure out how much that is. What's the PE ratio they give us?
12.8.
12.8. And what's the earnings per share they give us?
$1.97.
$1.97. So what does that end up being? 25.216. So what should I do with that number? Store 1, right? Just in case everything goes horribly wrong. Now, how am I going to get the market value of the equity? And keep in mind, this isn't per share, it's the whole enchilada. What do I have to multiply by? Ms. Wabi.
It's a really good question.
And she has no answer, I can tell.
No.
Ms. Wabi, are you a marketing person?
No.
Oh, wow, because that was a marketing answer. What the hell? Apparently, Mr. Green, you are just too good looking, and the camera keeps focusing on you. Okay, back to the story. If I take the number of shares and multiply by the price per share,
There we go.
boom! There you go. So we've got this price per share. How many shares do they say we have outstanding?
36,000.
Yeah, so multiply that by 36,000, and that gives us what's on the top here. Can anyone give me that number?
90776.
90776
7776.
7776.
My bad. 9077776. 9077776. That's what I
I might make you get up here and write this crap down. 90777
6.
and that's it. Is that it?
Yeah, that's the problem.
Okay. And then we're going to divide that by this number right here. Go ahead and do that. Someone, please.
3.09.
3.09. We did it. Now, how many steps did it take to get there?
Couple.
Took a couple, right? So that's a good solid B kind of question. If you could get that, you know, I think you might be able to pull a B. If you can't pull that, okay, back to the story. Any questions before we move on?
For some reason, I have market value per share is equal to number of shares outstanding times price per share, and then that's divided book value per share. I guess I understand.
Yeah. So this is the price times the number of shares. All right, that's the market value of the equity. That's how we got that. Are you with me?
Yeah.
Yeah, she sounds unconvinced.
The way that like I figured out how to do it, it told me to do total equity divided by shares outstanding on the bottom.
Yeah, you could do that too.
Yeah,
So we could have.
I have the whole thing, market to book ratio is on the top. Price earnings ratio times earnings per share.
That gives you the price per share.
Divided by
Uh-huh.
total asset divided by equity multiplier, and then divide that by numbers per
Right.
number of
So
shares.
what did she do? She basically put book value of equity in per share. And by the way, if you got per share on top and on bottom, you're good. If you've got total on top and on bottom, you're good. Mathematically, what she did is exactly the same, because dividing that thing on the bottom is exactly like multiplying the thing on the top, right? Just in case you've forgotten your algebra. You could do it either way. By the way, do I care how you get to the answer? Not one, as long as you're not cheating, not one bit. Okay, thank you for sharing. A firm has a debt to equity ratio of 0.5. Okay, firm has a debt to equity ratio of 0.53. What is the total debt ratio? Well, first let's talk about the definition for these two things. D to E is equal to TD over TE is equal to, they're telling us how much? 0.53. Okay, now the other thing that we know is the total debt ratio, let's just call it TDR, is equal to total debt divided by total assets. And so what I need to do is figure out some expression for total assets, and we'll work from there. So the first thing I'm going to do is I'm going to rearrange this top equation. And I want you to tell me if I violate any mathematical laws. TD is equal to 0.53 TE. Is that correct? Okay. Now, by the substitution principle, I can substitute this anywhere I see TD. And there's one more thing I want to tell you, that this bottom thing is just TD plus TE. Does that make sense? Okay, so now I can substitute this in anywhere I see that. So what I've got here is 0.53 TE divided by 0.53 TE plus TE. Have I blown anybody's mind yet? Just
It's a lot more
substitution.
complicated than this formula I used.
What's that?
It is a lot more complicated than the formula I used.
Well, maybe you can teach this one after I get done. Okay. But that was fine. I'm always pleased. Hey, by the way, folks, I learned how to do standard deviation on the calculator from one of my students. So that's not... Mr. Green, you're hogging the camera again.
Sorry about that.
Just so good looking. I think it's the shirt. Okay, there we go. I don't know what's wrong with you today. I give you electricity, what do you do to me? Okay, back to... Okay, so 0.53. By the way, what happens to the TEs?
Yeah.
They add, okay, so we can add this on the bottom. We add that on the bottom, what do we get? Yeah, 1.53. And so when all these things, by the way, I was looking for cancel out, right? This thing becomes 1, And so that becomes our total debt ratio, which is roughly a third, which is the answer. Now, Ms. Perry, would you like to share your?
Total debt ratio equals 1 minus, in parentheses, 1 over the equity multiplier.
Total debt ratio is equal to, what are you saying?
1 minus,
1 minus
and then put in parentheses, 1 over the equity multiplier.
1 over the equity multiplier. Okay, so let's see.
Apparently it's liking me now.
Oh, well, but your shirt's not nearly as attractive as his, so it must just be you. Okay, so. I feel like such a clown when it does that. I told you about my students online complaining. They're like, is your cameraman drunk? Right, sure. I would be if I had to, but never mind. Okay, so why does this work? It's equal to 1 minus total. So this is total assets over total equity. So this thing at the end is total equity over total assets. Does that make sense? Okay, now I'm going to multiply this thing by TA over TA. Because I can. It's no violation of the law, right? Because it's just multiplying by 1. And so that's TA over TA minus TE over TA. And that's equal to TD over TA. So there you go. If that works easier for you.
Which also the equity multiplier is just 1 plus the debt
Oh, yeah.
to
So-
equity ratio, which they give
So
you.
this is just 1 plus net equity. That's how she got the equity multiplier. But that's why it works. Questions?
So yeah, the easiest formula is the 1 minus the 1 over 1 plus debt to equity, which they give you.
Oh, okay. Well, so there you go. In case you see this very specific problem on the exam, you can use Ms. Perry's method. Otherwise, you can think through it. Questions? Okay. Let's see. So that's the end of chapter 3. Holy crap. Let's get to chapter 4. I was wrong about being able to finish it all. We'll get there though. We'll get as close as we can. Chapter 4. What's that? Yeah, the first one's 1, I believe. Oh, look at this. 13 of you haven't even touched this. I guarantee you it's going to be like sticking your tongue into a fan if you don't get after this. It's going to be awful. By the way, if you've never done that, don't, right? It's bad. It's like licking a frozen flagpole. Just don't do it. Okay, so here we go. First City Bank pays 6% in simple interest on its savings balances, whereas Second City Bank pays 6% compounded annually. If you made a $72,000 deposit in each bank, how much more money would you earn from your Second City Bank account at the end of 10 years? Okay. First, we're going to figure out the Second City future value. And it's really easy. Second, clear TVM. Why do I do that? Yeah, because the calculator's like a wife. It remembers everything unless you clear it out, right? Okay, back to, by the way, wives don't have that feature. So if you made a $72,000 deposit, $72,000, I'm going to go ahead and make that negative. What button should I hit next? Present value, very good. And how many years are we leaving it in place? 10. What should I do with 10? And then they tell us that the interest rate is how much? 6% and it's compounded annually, so this is what I'm going to do, 6i per y. And then what am I going to compute? Compute the future value. Is this what you get?
Yes.
Okay, now here's what I'm going to do. I'm going to store 1. Okay, now, how am I going to get the future value of the simple interest? Yeah, so it's going to be 72,000. And then, how much interest do I earn every year? I earn 6% of what? 72,000. And how many years do I get that? 10 years. So, here we go. 0.06 times 72,000 times 10. Is this what you get? Tell me yes or no. Is that what you get? Okay. So I'm going to store 1. And then I'm going to have to add 72,000. Oh man, I just copied over that, didn't I? Plus 72,000. Okay, so the future value here is going to be 115,200. Do you guys get that? Okay, so now I'm going to say, I'm going to hit the negative here, and I'm going to say plus, and then I'm going to see if I can recall the future value. Oh man, there it is. Because I wrote over it in the memory, right? $13,741.03. What part of this do students usually not get? This part right here. The simple part is the hardest for students because the calculator doesn't just spit it out for you, right? I had an online student ask me, how can I turn off compounding in the calculator? I'm like, can't do it, sorry. Okay, that was question 1. Now we're on to number 2. For each of the following, compute the present value. Okay, so basically, they're telling us, they're giving us the years, the interest rate, and the future value. What am I going to do with that? Yeah, plug it in the calculator. Second, clear TVM, 14,851. And I'm going to hit future value. I hit 8. What do I hit next? I per Y. And oh, what do I do with 14? And then I compute the present value. Now, why the negative sign?
Sign convention.
Yeah, it's the sign convention of the TIBA2 plus calculator. Stuff with opposite sign, cash flows with opposite directions have opposite signs. And so you can think of this as you have to deposit that amount of money to get back that future value. Does that make sense? Okay. Now, do I really need to go through each and every one of those? Because we got other fish to fry, right? Now that you know how to do one, you can do them all. Okay, now we're on to number 5. Yeah. At 6.1% interest, how long does it take to double your money? Oh my goodness, this is fun. Now, if you remember back to the formulas where we were talking about the interest rate and all that, the true value, the absolute values of future value and present value don't matter. It is the relative value. And so what are we going to do here? I'm going to say second clear TVM, and I'm going to say that my present value is -1. Now, if present value is basically 1, what should I set future value to in order to get my money to double? 2. Easy peasy, right? 2. Future value. Now, they say at 6.1% interest, so that's 6.1 I per Y, and what do I need to compute? N. Does that look right? Okay, now let's talk about here. This is an English lesson for today. What does quadruple mean? 4. So, what's the only thing I'm going to change? FV is 4. Now, here's the cool thing. If everything else stays the same, all I have to do is say 4 FV compute N. There you go. Does that make sense?
Could you just double the value you got for part A? Like, will that work every time?
You know, I know this works every time, right? I would do this. Yeah, I think, absolutely. Yeah. But don't trust that. Just use your calculator.
You get a rounding error.
You get a rounding error. Oh my goodness.
I mean, if you use the one that.
Oh, okay.
The 11.71.
Okay, very
Then
good.
you get 23.42.
Yeah, and luckily you got plus or minus 1%, which should get you home, but I digress. Any questions on this before we move forward? Okay, what's the next one? 7. And folks, keep in mind, these are questions from people who've actually done it, right? If you haven't done it yet, you're in a world of hurt. compute the future value of 2,500 continuously compounded for 5 years and an APR of 12 and an annual percentage rate of 12%. Now, notice they're saying continuously compounded. So what we really need to do, what we're given is an effect, or is a nominal rate. We need to figure out what is the effective rate. Let me show you the easiest way on earth to figure out your effective rate. Clear. Second, number 2. What does number 2 say above it? Yeah, well, it's interest rate conversion, and nominal here is this nominal rate we're going to put in. We put it in as a percentage, enter. What? What does C per Y stand for? Compoundings per year. What do I tell you in the lecture you can do to fool your calculator into thinking about infinity, which is, yeah, you just put in all the nines you could think of here, or it'll fit. Because that's what continuous compounding means, is compounding an infinite number of times per year. And then we arrow up, and I hit compute. And so that's 12.749, right? So here's what I'm going to do. I'm going to store 1, just in case everything goes horribly wrong. I'm going to say second clear TVM. They're telling me I'm going to put in 2,500, present value. I'm going to, so now I'm going to recall 1, put that in as my I per Y, because we use the effective rate, because there are no payments in the middle of the year. Now, they're asking us for 5 years, 5N. What do I calculate now?
Future value.
Yeah, compute the future value. Man, are we good or what?
Yeah.
We fooled the calculator. We didn't have to do any exponential stuff. I can tell you're unimpressed.
My calculator's messed up. Like, I do exactly what he's saying, I get it wrong. So.
Okay, can you come by this afternoon during office hours?
Yeah.
We will do the purification ritual.
I've tried. I think it's
And-
cursed.
Yeah, well, if it is cursed, then we'll need to cast it out into the darkness and get you a new one, right?
Yeah.
Okay. Or burn. Yeah, very good. He knows that the only way to drive out, no, that's not true. Okay, back to the story.
Technically, you have to burn the battery out. There's a lot of us.
Okay. We can ask our neighborhood Wiccan later on. Does there have to be a crossroads at midnight and some other shit? Okay, back to the story, because we got to get moving here. Do you guys need to see another one of those, or is that enough? Okay, you got the key. So, that means number 7 is gone. Now we're on to number 9. Investment X offers to pay you $5,700 a year for 9 years, where investment Y offers to pay you $8,200 for 5 years. Calculate the present value for these things if the rate is 6% and if the rate is 16%. So here's what we're going to do. We're actually going to do investment X first, and then we're going to do both A and B for investment X, and then we're going to do investment, the other one, and we'll do both for it. So get your calculator out. What's the first thing I do? Second, clear TVM. Investment X, $5,700. Let's see, per year for 9 years. So that's payment. I'm going to make it negative because the other one's going to be the opposite sign. You do whatever you like. What do I do with 9? And, right? And what do I do with 6%? I per Y. And what do I compute? PV. It's asking for PV. Okay, so there is that one. Now, the only difference between A and B is the change in the rate. So here's what I'm going to do. 16 I per Y, and then I'm going to compute present value. And so there it is. See it down there? Same thing. Okay, now, second, clear TVM. And I'm going to do the other one. It is 8,200 negative per, payment. And then 5 years. And I per Y is 6. No, we're doing A first. And we're going to compute the present value. That gives us 34,451, right? Now, how do I get Y for B?
Just change it.
Yeah, so I just go 16, I per Y, compute present value, and you're good to go. Any questions?
Why is it called discount rate?
Oh, okay, because it's the rate at which we're discounting that future value. As long as the discount rate is positive, then our present value will be smaller than our future value. And why are we only willing to purchase this at a discount? Because we have to wait, right? Because of the time value of money. So we're not willing to pay full price for these cash flows. If we were, all we would do is take 5,700 times 9, right? I guarantee you what we get here is less than 5,700 times 9. Questions? Good question. Oh yeah, we have many names for it. The discount rate, the interest rate, the market rate of return, the required rate. It's crazy, I know. But welcome to finance. Questions? Okay, now I believe we just have one left. Yay!
I will say questions.
Yeah. Well, so let's look at question 16. We'll discuss how we go about it. And then, folks, this could save your life. Please, just watch. I just need you for like 8 more minutes. Okay. You're planning to save for retirement over the next 25 years. To do this, you're going to invest $700 per month in a stock account and $300 per month in a bond account. The return of the stock account is expected to be an APR of 9%, and the bond account will earn an APR of 5%. When you retire, you'll combine your money into an account with an APR of 6%, and they want to know how much can we withdraw each month. So let's walk through what's going to happen here. I'm going through here, and every month I'm putting in for 25 years. And then I'm going to have a future value, and I'm going to have 2 of those. I'm going to have one for the bond account, and I'm going to have one for the stock account. Then I'm going to add those 2 together, and they become the present value for the rest of this stuff. And then we're going to figure out what is the payment going to be beyond that. So let's go ahead, and since I'm actually working the last one, I'm just going to erase all this stuff. So we need the future value bond, and we need the future value of stock, and that's going to be the present value of the retirement account. So first thing let's do is figure out that future value of the, let's see, we'll start with the bonds. What do I do?
Second clear TVM.
Yep, second, clear TVM. Now, they tell us we're doing it for 25 years. What should I put in for N? Wrong.
No, 33.
It's
100.
25 times 12. Y times 12. Yeah, so we're doing this monthly, right? Okay, so that's N. And how much is that bond? It's returning 5%. What do I put in for I per Y? 5 divide by 12. Because APR is the sub-period rate times the number of sub-periods in the year. And so if I divide by the number of sub-periods per year, that gives me the sub-period rate, right? And so we're going to say 5 divided by 12 equals, and I'm going to hit I per Y. Got to hit equals because for some reason it doesn't work otherwise. So now we've got N, we've got this. What's the other thing we need to throw in here? Yeah, the monthly payment. I'm going to make it negative since I'm putting money into this pig. And going to hit payment, and then what do I compute? Compute future value. I'm getting $178,652.90. Does that make sense? Is that what you get? Okay, I'm going to store that as number 1. And I'm going to write number 1 right here. Now, what's the next thing I need to do? Yeah, the stock. Now, let's talk about this. The number of periods is exactly the same, right? What are the 2 things that are different? Yeah, the I over Y and the payment, right? And so the return on our stock stuff is supposed to be, what, 9%? So 9 divided by 12 equal I per Y. What's the other thing that's different? 700 PMT. What should I compute now? Compute future value. I'm getting 784,000. Is that what you get? Okay, I'm going to say store. Oh, wait a minute. I'm going to hit negative here. And it's store 2, right? Because if I recall 1, yeah, there we go. Okay, so this is now in location 2. What do I do to get the present value? On my calculator. Yeah, add them up. What button do I hit first? Recall. Recall 1 plus recall 2 equal. That's going to be the present value for that last bit, right? Now here's what I'm going to do. I'm going to say second, clear TVM. I'm going to make this thing negative so my payments come out positive. How many years do I plan to live? 20. Isn't that terrible? You have to plan how long you're going to live. Okay, 20, but is it 20 for N? No, because I want to withdraw on a monthly basis. So I'm guessing it's 240. Does that make sense? Okay, now you're going to be getting an APR 6%. Is that I per Y? 6 divided by 12 equal I per Y. And then what should I compute? Payment. Looks like I could pull out $6,902.37 per month. Does that help you?
Yeah, but I figured out it's because my calculator.
I think other people wanted to see it too,
Yeah.
so don't feel bad. We really do need to, in fact, just come up after class and we will,
Okay.
right? Questions? Okay, if you have questions between now and the time you take the exam, send me an email, copy and paste everything into it, and I will try to help you out. What time do you have to be in the exam answering questions by? 7:59 p.m. Springfield time. Here, make it happen.